All right. Well, I guess I'll just present my screen and start sharing. So this presentation is called Top 5 Things a Passive Investor Should Know Before Investing. And this is centered more around if you were going to invest in a syndication as a limited partner. So without further ado, all right, can everyone see my screen?
There you go. Got it.
Okay, well, you'll have to excuse my poor PowerPoint skills. I'm a numbers guy. I'm not very good at making things look pretty.
You were
But
you were
I hope
supposed
it
to
all
send
makes
it.
sense.
You were supposed to send it to me to make it look pretty.
I did send it to you.
I know, but then I didn't have time to make it look pretty. I'm sorry.
Yeah. I was like, hey, can you check this over? That's what you're good at, Emma.
I totally checked it over. I just didn't do any prettying of it. But it's the information that's good.
Emma, next time send it to me. I'll do it. I'll do it pretty. I got you.
That's a good idea. Maybe next
time. Madeline? Oh.
Yeah.
Okay, I'm adding you to the Rolodex. I'm always looking for people that can make my work look pretty.
Yeah, I got one more for you too. I'll introduce you guys. And a VA.
So anyways, top 5 things a passive investor should know before investing. So thing number 1, I'm going to start off with the typical fees that you're going to see if you're investing as a limited partner in a syndication. And I think these are, for the most part, pretty common. This is what I would look for if I was investing. So you're typically going to see an acquisition fee and an asset management fee.
Hey, John.
And then
one quick thing. Up in the corner there where it says present on your slideshow, click that and you get full screen. There you go.
Okay. So the typical fees you're going to see in a syndication are the acquisition fee, the asset management fee, and then you may see a refinance fee and a disposition fee. But the acquisition fee and the asset management fee, those are the 2 most common. So what exactly is the acquisition fee? The acquisition fee is paid to the general partnership team to compensate them for the time they've spent looking for the deal. They've probably put up some at-risk capital, which is like earnest money deposit, money for an attorney, inspections and due diligence, travel costs. And this money is called at risk because if the deal doesn't close, the general partnership team is just out this money. Like they lose it completely. And the acquisition fee is a way for them to get some of that money back and compensate them for their time, as well as just help them get a little bit of cash, because sometimes it takes a little while for these deals to actually start cash flowing well. Typically, it's a percentage of the purchase price. So if you're buying, let's say, a $1 million property, if there's a 1% acquisition fee, that general partnership team is going to get $10,000, which is 1% of $1 million. So what I would like to see for an acquisition fee is generally between 1 and 2%. And even after that acquisition fee is paid to the general partnership team, they should still have some skin in the game. So if they're in the deal for like $20,000, they shouldn't be taking a $20,000 acquisition fee. Anything over 3%, I think, is a red flag. It's excessively high, in my opinion. I think 3% is even a little high, but I've seen some deals where they're offering a 3% acquisition fee, and I think there are some circumstances where it's okay. But what I would really rather see is a higher asset management fee than a higher acquisition fee, because the asset management fee, that's actually more performance based. So if the general partnership team is performing really well, then the asset management fee is going to be higher. Whereas if they take a high acquisition fee, they just get all that money up front, and if the property doesn't perform, well, they've already got their fee. So question, if you're investing in a $5 million profit, what's the highest the acquisition fee should be? Any takers?
Any math people?
$50,000.
What's the?
Let's say $150,000.
$150,000. That's probably pretty close. I was gonna say, what's 2% of 5 million? I'm the numbers guy. I should know this.
Here we go.
100,000.
Yeah, 100,000. Yeah, so 100,000 is probably the highest I would want to see the acquisition fee on that under, normal circumstances. You guys are better at math than me.
You can only do math on a spreadsheet.
All right. So then, what is the asset management fee? The asset management fee is paid to the general partnership team for actually running the day-to-day operations of the property. And there's a number of different ways you may see this calculated. It could be a percentage of the collected income, the net operating income, or the property's cash flow. I'm going to assume, or at least when I underwrite it, I use it as a percentage of, I believe it's a percentage of revenue. But I typically run the numbers between 1 and 2%. And again, I'm okay going higher on the asset management fee if the acquisition fee is low, because I want the general partnership team to be incentivized. And they're constantly paid throughout the deal with the asset management fee, as opposed to that acquisition fee where it's just like, yep, you get all the money up front, and now, where's that carrot to kind of string you along? So are there any questions about the asset management fee and the acquisition fee before I go on?
Now, the asset management fee is typically paid monthly before anybody else gets paid anything. It's one of the first fees to come out of the cash flow. And do you see it formed, taken out at different points of it, after the investors get paid for the monthly cash flow or before?
I've heard it each way, where sometimes it's after the investors get paid, other times it's before, because the general partnership team has overhead. I mean, as a limited partner, I would definitely want to get my returns before, the GP starts taking an asset management fee. But, as a GP, I'd want the asset management fee before my limited partners get paid their distributions. So I think you're going to see that go either way.
I think Dorian has a question.
Yep. So I can't see the screen. So just.
Yeah. Can you hear me?
Yep, I can hear you.
Yeah. On that asset management, I've seen and talked to some operators, and this is kind of different, but they sometimes prefer to pay the asset management after the performance, and just because it's like a service to the LPs, and that they're performing the right way, if that makes sense.
Yeah, you mean after the preferred return?
No, what I'm saying is that after they pay the investors, then they get the asset management, and not before. It's just the way. I mean, what I've seen the most is usually get the asset management, like Emma said, just part of the operation expense. But there's some operators that they do it the other way. They pay first investors, and then they get the asset management.
Yeah, I've seen that go both ways too.
One thing I wanted to point out, for those of you who are aspiring new passive investors trying to figure out how can you tell if a deal is a good deal and all that, or if you're an active investor, these are the kinds of things that you need to be explaining to your passive investors. These are the questions that they have. And so if this is stuff that you already know and you are already doing, kind of try and dial back your mindset to the point of when you didn't know anything about this, and remember what your passive investors were going through and some of the major issues that you need to be in front of and explaining to them as you're working with them in order to invest in one of your deals. So either way, whether you're active or passive, these are the things that you need to talk to your investors about, and they'll feel more comfortable with the deal, and they will invest more confidently.
I would also say, regarding the asset management fee, if you're a limited partner or passive investor, there's expenses that the general partnership team is incurring that the property is not paying for. Like if you're doing a syndication, you're going to have an investor portal like Syndication Pro. that can be thousands of dollars a year. And then when it's time to file your taxes, you're going to probably hire a CPA to do the taxes for your property. That also may not be something that you see coming out of, the property's cash flow. And the asset management fee can help cover expenses like that you may not see. Okay. And then here's just a little illustration of how the asset management fee incentivizes the GP. So it shows the rental income in year 1 and year 2, and as the income goes up, so does the asset management fee, thus aligning the general partnership's interests with the limited partners. And then now we'll get into the refinance fees and the disposition fees. These are a little less common, but the refinance fee is paid to the general partners when a property is refinanced, and it's typically a percentage of the refinance proceeds, and the most I've seen with this is 1%. And if you can ideally get into a deal where this is tied to performance objectives, so like they're meeting certain returns or they've hit certain thresholds before they can get that refinance fee, that would be ideal. And it's pretty much the same thing as the disposition fee, but instead of this occurring when the property is refinanced, it occurs when the property is sold.
I was kidding.
So any questions there or comments?
I think this disposition fee is one I don't typically see, but when I do see it, it's usually because there's a lot of work that goes into getting a property ready for sale. For the property manager and for the general management team. Just working with the broker, getting all the financials, getting the deck done, getting the place cleaned up, ready to show, showings. It's kind of expensive to get a property ready for sale if you want top dollar for it. So I think if you see this fee, don't be too concerned about it. It's not in most, but if you see it, it's pretty reasonable because of all the extra work that goes into selling it.
Yeah, and you might have to pay your staff like bonuses so they don't just get up and leave in the middle of the job. So the disposition fee could cover you for some of that too.
Can you explain the refinance fee again? Why would you want to pay your general partner a fee when you're refinancing it?
So as a limited partner, I don't think you really want to pay your general partnership any of these fees because that's coming out of your returns. But what it is the refinance fee is if I'm refinancing a property and let's say I get a new mortgage for $1 million, if there's a 1% refinance fee, the general partners are going to get $10,000. And there's work when you go to refinance a property too. There can be headaches. So I don't think it's totally unreasonable for there to be a refinance fee. To me, it's just if there's refinance fees, disposition fees, and then there's high asset management and acquisition fees, it starts to look like a fee shop. So I think I would take it all kind of together instead of just like dissecting it piece by piece.
Hey, John?
Yeah.
So how do you keep your, like if you're a passive investor, how do you keep the GPs from charging things to a property that shouldn't be, like maybe some of their overhead, their travel expenses, things like that shouldn't necessarily be tacked onto the property. But so how do you watch that?
Well, if you're an LP, they should be sending out like quarterly statements for you, so you could watch it there. But unfortunately, in a syndication, it's not like these companies are being audited by a Big Four accounting firm. So you're kind of relying on the GPs to give you trustworthy information. And if they're charging additional expenses to the property, that's going to make the income and the returns look worse, which is only going to hinder their track record. So if you find reputable sponsors, I don't think they really have any incentive to do that if they want to continue doing deals. I don't know, that's a good question. I'm honestly like not 100% certain about that.
Well, as a limited partner, you should be expecting good communication throughout the life cycle of the deal. So maybe a monthly email from the owners with pictures and just a summary of what they renovated, what they rented, how the progress is going. And quarterly, you should be expecting a full financial report. And if you're feeling at all uneasy about what's going on, you can comb through that, and you can even bring it to one of your accountants and have them comb through it. If there are irregularities there, it needs to be addressed. And so limited partners typically don't have any control over the deal. You're buying a security and turning the control of your money over to a business. And so, but the communication is really important. If there are concerns or if there are things going on, it's a much smaller business. And you have direct access to the owners. And that's a question you ask yourself. Do I have direct access to these owners? How well do I know them? How well do I trust them? If there are concerns that are coming up about questions or irregularities, how easy is it to get a hold of them and have them explain that? And just be prepared, especially if it's your first time with an operator. Just make sure they're doing a good job. Most operators in this space would be screwing this up, not necessarily because they're being dishonest, because like John said, it doesn't suit them and their reputation if they want to keep working. But you're going to see some incompetence here, especially in the accounting, and you got to make sure when you're investing in a deal, who's doing the accounting, how are these reports coming out, how am I going to get information, because those are really important questions. It's not just the financial statement that you get when you're investing in the deal, but it's all the financial statements you're going to get throughout the deal cycle.
Okay, so they send out like pretty much every transaction on those quarterly reports. Is that right?
You'll see a profit and loss statement, and it'll have line item expenses, but you won't see every transaction. We have it. But it would be hundreds and hundreds of pages long, right?
There's a lot of transactions.
Yeah.
On a day-to-day basis. You would have to like, that's what auditors do when they audit these large companies. And even the auditors, they're only taking a sample of all the transactions and between the profit and loss, the balance sheet, the cash flow statement, because there's just so many that happen. Like, you would be going through transactions where your maintenance person went to Home Depot and spent like $50 on material to replace doorknobs and, patch a hole in plywood.
Okay, cool. Thank you.
Okay. So the second thing I think that's really important when, before you invest in a deal passively, is whatever that operator is telling you, the returns are going to be, it's being driven by the net operating income, and just give that net operating income a sanity check to make sure they're not being way too aggressive with their assumptions. And the biggest drivers you're going to see in the net operating income are the rents, the vacancy, and the expenses. That probably sounds pretty obvious, but rents are huge. Like, even the slightest uptick in rents is going to drastically impact your net operating income, and the same with the vacancy. And then with the expense ratio, if they're saying they're going to run at like a 30% expense ratio, that's really aggressive in my opinion. Normally, I would say it's going to be between 40 and 60%, depending on the market and depending on what the type of property is going to be. And you can check the property taxes too. Call the county assessor's office or ask the operator if they have a tax appeals attorney and figure out how the taxes are calculated in that market. Because I've underwritten deals where they look good, but if you change the property taxes, it can take a good deal and absolutely crush it. So if they get that line item wrong, one, who knows what else they're getting wrong in their underwriting. Taxes should be pretty automatic if they're using the right resources. And, if they have it wrong and they're just saying it's going to go up a little when really it's going to go up a lot, that's going to have a huge impact on net operating income, thus the value. So with the rents and the vacancy, that sponsor should have some rental comps that they're using to pull their rents for. You can ask them for the list of the comps, and you can literally call those comps up on the phone and ask what they're renting for. So if the sponsor is saying, yeah, this comp is asking, or this comp is going to rent for $950, and that's where we got our rent for, and you call them and they're renting for $950, but they have 1 month of free rent, and the sponsor didn't indicate that, that's going to have a huge impact on what their real rents are going to be. And your rents are the biggest driver of your returns. So if they're not going to hit them, the deal in all likelihood is not going to work. And then with your vacancy, even if you're in an incredibly hot market like Arizona or Dallas or Atlanta, they should still be underwriting between 9 and 12% economic vacancy. And if they hit 95, 96, 90, 97% occupancy, that's great. That's a cherry on top. But they shouldn't be relying on that to hit their returns. And so I have this little video that shows you, this is how big of a difference 5% occupancy makes in your deals. Okay, I'm going to show you the different percent uptick in economic vacancy can make in underwriting a deal, and something of an impact this can have. Check it. So right now, we're looking at this deal I underwrote a while ago. We're looking at 10.5% average cash on cash and about 15.5% XIRR. And our stabilized economic occupancy is about 90%, which is pretty fair. If I go change this to 95% economic occupancy, we just went from 15.5 to 21.5, and 10.5 to almost 15. So our returns just went up about 33%. Pretty huge difference. So, that's what 5% on your occupancy is going to do. It's going to take your returns from 10 to 15%, and that can definitely make a, okay looking deal look great.
Okay, I was kidding this time.
And then with the taxes, like I said, just double check them. The sponsor should give you their underwriting if they ask for it. And scrutinize that tax line, call the assessor's office, call an appeals, and just make sure they got that number right, or at least they have good reasons for why their tax number is what it is. And I'll give you an example of a deal I was looking at in Jackson, Mississippi, of all places. I ended up calling their tax appeal, or a tax appeals attorney, to figure out how taxes were calculated in their market. And he gave me the formula, which is usually the assessed value times whatever the millage rate is in that market. And in the broker's OM, he had this number that looked really low for pro forma taxes. But what the appeals officer ended up telling me, or what the appeals attorney ended up telling me, was in that county, there's only one tax appraiser for all commercial properties. He did land, retail, office, apartments. He was old. He was on the verge of retiring. And frankly, he was lazy. And so he always underassessed the properties by 50%. So that was game changing when I was analyzing the deal, because he was your numbers are way too high. So if your sponsor has a story like that where they can actually back up a number, that makes a lot more sense. But if they just didn't do any work and they're saying taxes are going to go up 10%, when in reality they're going to get reassessed on the purchase and they might double or triple, which I've also seen, that's going to absolutely kill your deal. And then on the expenses, look for something between 40 and 60%. 40% is pretty low, but if you're in a high or a low tax, low insurance market, it's possible. Also, if the rents are higher, above $1,400, expenses tend to be kind of fixed. A piece of carpet is going to cost what a piece of carpet costs, whether your rents are $600 or whether they're $2,000. And 60% is going to be more on the high side, but that could be in like low income areas or areas where there's extremely high tax and insurance rates. So think of like Texas.
I think why this is useful is the property taxes and other expenses are included in this 40 to 60%. And so if you're seeing it way off, much, much higher or much, much lower, that's when you start looking at the line items, right? But I would check the property taxes anyway, just because if they're saying it's 50% and the taxes are going to be a lot higher because they reassess you, it could shoot up to 60% really easily, especially in places like Texas, where they have high disaster insurance, and also they have high property tax rates, because states with no sales tax are going to have higher property tax rates. So you don't have to be a forensic accountant to pick through what the guy is sending you, but if you see something that's way below 50% expense ratio, or if you're in a high tax, high insurance state and you're seeing below about 57, 58%, look into it.
Yes, I mean, you look for deals in Texas. Like, is that the expense ratio you're seeing?
Yeah.
Like,
55, 58 is not uncommon.
Yeah. Like insurance and taxes, those are expenses you have no control over. So all else being equal, the expense ratio is going to be higher in those markets, unless the rents are really high.
You're also going to see lower expenses on newer buildings. So our new construction, we underwrote it at 37% expenses, and the people that we're sharing that deal with are not challenging that, because for a new building, 30, 35, under 40% is not uncommon, but those expenses have got to escalate as the building ages. And so keeping that in mind, a newer building is going to start with a lower expense ratio, but if they keep it at 40% for the entire life of the deal and their pro forma, by the end of it, it should be closing in on 50% after 5, 7, 10 years. So I just know with new construction or very new construction, it will be lower, but it should be going up every year, the ratio.
Your rents are probably pretty high in new construction too.
Yeah, it doesn't go up as fast. It's not going to get to 50% sometimes by year 10 if you're in a really high rent area, because your rent's going to be outstripping your expense growth. So say 6% rent increases to 3% expense growth in a downtown area is not unusual. But if you're in a suburb, garden style apartment, the rents are not going to go up that fast, and the expenses are going to go up and they eventually catch up.
Okay, so that was that's what I call the NOI sanity check. Before I go on, does anyone have any questions, comments, or things that they want to discuss? Nothing?
I would like to say, when you start looking at deals, when you're in networking with operators, you should try and meet as many operators as you can and get on their notification list so they start sending you deals so that you can start looking at them. Because just like we need to find a great deal, if we find one, we got to act and jump on it really fast. Really good deals sometimes are overfunded. People get in a little too fast, especially if the operator is really good at what they do. And so if you want to jump on it, you don't want to miss out on one because it took you 10 years to analyze the thing. So just like looking for a deal, spend about 10 to 15 hours educating yourself about what to look for on the front end. Start looking at deals. Call us, ask us. If you have any questions, post in the group. You're going to want to get pretty quick at evaluating these, a day or two, and commit your funds, especially if it's a really good deal and you think it's going to be funded quickly or overfunded. So don't be overwhelmed. You don't have to do this you don't have to invest in the first deal you look at. Don't agonize over it. Just start looking at deals. Try and do a couple of months so you get comfortable with it.
Okay. So the third huge thing that you should look for as a passive investor is your exit cap rate. And after your rents, this is the second biggest driver, in my opinion, in projected returns. Almost 99% of the time, you should be projecting a higher exit cap than your going in cap rate. And what I mean by going in cap rate is when it's with your numbers. And I guess I'll give an example for that. If you're looking at deals, you may buy a deal that is like a 10 cap according to the trailing 12-month profit and loss, but that owner may have like a 25% expense ratio because they're just, they're not including all of their expenses, and it's not realistic. But if you were to input your numbers in there, it may be like a 5 cap. So in that case, you may go down from like a 10 cap on going in to an 8 cap on the exit, but really it's like you bought at a 5 cap and you sold at an 8, that's totally okay. And the reason that exit cap should be going up over time is because, like Emma said, the building gets older, and so it theoretically gets less valuable, even though the net operating income goes up. Really, the only time I would say it's okay to not have a higher exit cap is if you're doing a huge renovation on the building and you're repairing or replacing like electric, plumbing, HVAC, new roof. If you're doing that type of work on a property, you can take something really old and you can essentially make it newer. And the real reason that we make our exit cap higher is because the building's getting older. So if you're doing something like that, maybe the exit cap doesn't get higher, but almost every time it is going to get higher. And the general rule of thumb is 0.1% for each year. So if you're going in at a 7 cap and you're selling in 5 years, you should probably be using a 7.5% exit cap rate.
Can I hop in here and just quickly explain what a cap rate is? For anybody in here who's, or anybody who's watching this later, cap rate is pretty much the net operating income, which is your net profit, divided by the price that you are paying. And it's a percentage of basically how far your money's going. So if something's only earning $1 and you're going to spend $1 million on it, that would be a ridiculous deal. You would never buy that. To take 1 divided by 1 million, it's almost nothing, right? So that cap rate is not going to be worth buying. A Class C property in a secondary market like a capital city in a Southwest state, Class C is older, in the 80s, 90s, is going to be about a 6 cap typically. If you're seeing much lower than that, you're usually in a primary market, Dallas, the California coast, Seattle, places like that. They're going for some of them 1 and 2 cap rate. And that's a good deal there if you can get it better than that. So when you sell it, you're going to take the net operating income that you bumped it up to, and you're going to divide it by the price that you're selling it. And that would be the cap rate that the new guy is coming in to pay for it, right? And so if you are saying, well, I bought it at a 5 cap and I'm going to sell it at a 5 cap, that's probably unrealistic because the building is older. So that's where you get cap rate from. The net profit divided by the price that you're paying for the property.
And if there's any stock market investors here, cap rate is like the reciprocal of price to earnings.
Oh, John, 99% of the time exit cap rate should be lower than your going in cap rate?
That's a typo. It should be higher.
Higher. Okay. Good catch.
Yeah.
Does that include value add? If you want a significant value add, you still expect the cap rate to be higher when you're exiting?
Yep.
If it's a really heavy lift and massive renovation, you're going to reevaluate it. So people say the commercial real estate is valued by how much money you make. And so you have control over the value of your property, which is only partially true. The other part of your property is going to be valued against similar properties. You're just going to have sales comps just like a residential. They're going to say, okay, this property was making this much, sold for this much, here's the cap rate. And so they're going to apply that same general cap rate to your building if it's similar. And so you are competing against the other buildings around you. How can they compete? And if the building is getting older, if it's significantly different than yours, obviously it's going to have a different cap rate applied by the guy who's evaluating it. It's more complicated than that, but boiling it down, your net profit drives your value along with the cap rate for similar properties. So if you do a massive renovation, you are now no longer like that similar property. And you're going to basically be compared to nicer properties, and you're going to get a lower cap rate evaluation. And then Tate, I saw you asked a question there, but I missed it. You want to unmute and ask that?
Wait, what? Sorry, I'm not seeing who asked, but
let me see.
It sounded like there was a follow-up question.
Yeah, I had well, not a question. I mean, just I don't know if you can explain what cap rate represents as far as like when we invest in certain property, because like Emma was saying, there's different cap rates around the country. So what it represents, the cap rate, the number.
So cap rate is how much you're willing to pay for $1 of net operating income. So if a property produces $1 of net operating income and it is selling at a 5 cap, that means an investor is willing to pay $20 for each dollar of net operating income. The lower the cap rate, the more an investor is willing to pay for each dollar of net operating income. And this is where the age of the building and the market starts to come into effect. Because if you're in like a great thriving primary market like Phoenix, Arizona, investors are going to be willing to pay more for each dollar of net operating income than if you're in some rural town in the Midwest. And then if we take it the same market and even the same neighborhood, we'll take Phoenix again, investors are probably going to be willing to pay more for some property that was just built than one that's 50 years old. And so that's what cap rate represents.
So, yeah, no, it makes sense. So would you say that the cap rate is proportional with the returns?
I'm sorry, I'm not really understanding what you mean.
Yeah, like the lower the cap rate, the lower returns, higher cap rate, higher returns.
So this is a very interesting discussion, and it's going to depend on your philosophy and what you want out of a deal. When you're talking about cash flow, yeah, it tends to be a lower cap rate, does equate to lower returns. But if you're planning to flip the property or refinance it, then a lower cap rate can be the best of both worlds. Because if I'm buying newer properties in Phoenix, every dollar I raise the net operating income, I increase my property value by $25. Whereas if I'm in some rural unknown town in Wisconsin buying old buildings that trade at an 8 cap, each dollar only raises the value. Each dollar I increase net operating income only increases the value of the property by $12.50. So are you seeing what I'm saying?
Yeah. So would you say that a higher cap rate would be a riskier investment, or?
Yes, that is exactly what I'm saying.
So the lower cap rate is safer to invest, but lower returns sometimes.
Yeah.
So
it depends.
It's lower cash flow, but it's potentially more money on the sale or the refinance, which in theory does make it, well, it's lower risk, but that's why I say it's like the best of both worlds, because it's lower risk, but they appreciate more. And you would expect some newer property in Phoenix to appreciate more than an old property in the middle of nowhere in Wisconsin.
Yeah, it makes sense. I mean, it's a kind of like safer markets or growing markets like Austin or like Atlanta or something like that. The appreciation it's pretty good, but there's probably not enough or not the desired cash flow. But still, I mean, you can find pretty good deals.
Yeah, and so another thing about cap rate, you can buy at a really low cap rate if you're doing a value add deal, because you're going to increase the income and the net operating income. And I always use development as an example. If land were valued on just cap rate, people would be giving it away for free because it usually doesn't produce much money. But developers, when they look at a plot of land, they're seeing what that building is going to be worth once it's completed and stabilized, and then they're backing into their numbers. So they're buying that land at a 0% cap rate, and then they might get it up to an 8, 9, or 10% cap rate by the time it's all said and done, and they'll go sell it at 4.5.
So this is a good point that I think Tate was asking in the chat. If you find a deal that is trading for lower than the cap rate for similar properties in the area, so for example, let's say similar buildings are trading for a 6 cap, and you're coming in and you're paying less for whatever reason, and you're getting an 8 cap, and you can predict 7, 8, 10 years down the line that's not going to maybe go for a 6 cap again because the market shifts. You just partially putting it higher is just a conservative move, because if the 6 cap is the market now and 10 years from now those older buildings are all still selling for a 6 cap because maybe the cap rate compressed market wide, you can kind of predict, okay, I bought it at an 8 cap, it should be a 6 cap, and 10 years down the road I'm going to sell it for a 6 or maybe a 6.25. So that's a reasonable strategy. I wouldn't say that you would always want to see your exit cap be higher. You just want to make sure that it's reasonable in the market that you're in, because if you want to maximize it, you're not going to sell it at an 8 cap, you're going to sell it at a 6 cap. You just got a really good deal. It's a kind of a yield, the differential between what you paid for it and what you're going to sell for it. And that's just like wholesaling. So that does happen. You just have to know the markets might not stay at that cap that it is right now 7, 8 years down the road. It's hard to predict. So just be conservative. If you and it's a red flag. You don't have to know how to calculate it. You just have to see if there's a big red flag. Then if the cap rate is significantly different on the exit than it was on what you bought, then you kind of have to ask yourself what's going on, and just look into it. Mm-hmm. And it's a red flag. It's not necessarily a deal breaker.
Yeah. Caveat with that though is I think most people are, I say this with air quotes, overpaying, because on value add deals you do tend to buy at a lower cap rate, and the numbers can still work with that.
Mm-hmm.
But yeah, like if you find a great deal like a wholesaler would, then yeah, you also would need to necessarily say that the cap rate's going to get larger. But we could talk about cap rate all night. It's a really interesting discussion.
I think operators and new investors tend to hang their hat on cap rate first, because it's like it's a very simple calculation, net profit divided by price. And so people can figure it out pretty quickly what cap rate means, and they tend to make that their first pet metric. I'm going to look for this cap rate, this cap rate, this cap rate, and can look at that and disproportionately weigh how important that is. And then as you get more into it, you might find other pet metrics that are really more important to you than cap rate, like returns. And some people will say, okay, what's the yield on cost? What's the cash on cash return? And some of these things I don't care about as an investor. I don't say I don't care anything, but there are things that are going to be more important to you, and there are things that are going to be more important to me. So don't overvalue cap rate. Don't put too much weight on it. The more of these metrics that you learn, the more of a balanced approach you're going to be able to take to it. So it's like, just because you figure out cap rate first doesn't mean that that's the way you evaluate a deal. You need many, many points of ratios, and the more you understand, the better decision you're going to make on your investing.
Well said. Okay. Anything else on cap rate? Any other questions?
Tanner has his hand up. Tanner, you want to unmute?
Yeah, I can't see you guys, so just ask away.
Okay, what kind of cap rate would you expect on new construction versus a value add? I mean, I know that's like a super broad question, but
Yeah, it depends on the market too. But are you talking about like what cap rate would you sell it at?
Correct. Yeah.
It really depends on the market. Downtown Salt Lake City, for buildings that are less than 2 years old, are going for like a 4.25 to a 4.5 cap trade. But the older they get, the higher that cap rate's going to go. So and it's just like a used car. It's going to hold its value longer than a brand new car. So you're going to see that cap rate rising more rapidly in a new building than you would in a building that's already pretty old.
Right. What about appreciation? If appreciation happens, doesn't it go the other way, although the building gets older?
So that's a great question. The cap rate may tend to go up over time, but if you're in a growing market like Salt Lake City, your rents are also going to be going up too. So if rents go up 5%, expenses only go up 3%, your net operating income probably went up like 10%. So if net operating income goes up 10%, even if your cap rate went up like 0.1% a year, your property value still went way up.
This is why you can't have just one or two pet metrics that you weigh your decisions on, because a lot of it depends, and it's kind of a scatter plot where they interplay with one another. Some deals you're going to have, this is going to be great, and this is not going to be so great, and the next deal it's going to be different. So having a couple of different metrics that you understand will help, because otherwise you just get tunnel vision.
Yeah. Anyone else?
All right, how we doing on time, John?
It's 9:17, so Eastern. I mean I'm fine. On time.
Do you have a zillion more slides or just a few?
No, I think just a few.
Okay.
I mean, we're on number 4.
All right. I would like, once the presentation is done, I would like to invite everybody to stick around and do a little bit of a networking, just a quick like 30-second haves and wants. Introduce yourself, and some of us are starting to see each other month after month. So this is how you find people to do business with, or these types of things.
Okay, well then we'll roll through this especially financing. I think it's important to know what type of loan that the operator is putting on the property, because that's going to be a good indication of how long your money is going to be locked in. If you want to be in and out of a deal in 3 years, you probably want to invest with an operator that's using a bridge loan, which they're basically the hard money loans of multifamily. And this is what operators will use to essentially flip properties. Now, if they're doing like a loan assumption where they're taking on a Fannie Mae or Freddie Mac loan, these are typically called agency loans. And the loan has a 10-year term and a prepayment penalty called yield maintenance. It means they're probably not selling that property for at least 7 years. So if you want to get your money back in 2 or 3 years, that's probably not the deal that you want to invest in.
I would say one more thing about financing. 2 more things. One, it drastically changes the returns on your deal. The better your loan, the better your returns are going to be. And so people are sometimes trying to skimp on the on the renovations when it only makes slight differences in your returns. Like, oh, we got to do cheaper this, cheaper that. Now, don't ever over-improve, don't overspend. But the loan and the price of the property are going to change your returns in a lot more dramatic way than most any other marker. So if they have really expensive money and they can get a better loan, then your returns are going to go up. And if they're looking at really, really cheap money and you're like, that's not realistic. I mean, it's not 90% occupied. They're not going to get a regular loan. They're going to have to get a bridge loan if it's less than 90% occupied, or if there has a lot of work that needs done, they're going to have to get more expensive money. So that does drastically affect your return. So just keep an eye on if the money seems too cheap to be true, or if the loan that they're purporting to get is not a good fit for the property itself, and then they're going to come back and be like, oh, well, that didn't go how we planned. And that's kind of just a sign of an inexperienced operator that doesn't understand what normal loans should look like. So pay attention to it. You don't have to understand every little nitty gritty of it, but you got to know if it's a normal loan for the property type.
Can I ask, why would you hold a building 10 years when cost segregation can only go up to 7 years, right?
Well, cost segregation, when you put bonus depreciation into it, it could potentially happen all in the first year. But it depends what that schedule looks like. Some of those parts, they may fall into the 20-year schedule, and I think bonus depreciation is anything that falls within a 15-year depreciation schedule gets pushed to year one. But they're like taking all the parts of the property and putting them into buckets. So if that cost segregator says, the windows are going to be depreciated over 20 years, you're going to get depreciation on the windows for 20 years. And then the other thing I would say is depreciation is a really important thing to look at, but it's not the only thing to look at in a deal as a passive investor and an active investor. Some people just have money that they want to park, and if they can get a good cash flowing asset in a strong market with long-term fixed rate debt, that's a good investment for them.
Another reason I see it is if you're in an opportunity zone, 10 years, your capital gains go to zero if you hold it there. Another reason I see it is if you get all of your money back at the refinance, you basically have a BRRRR, 100% of your money out. Why not keep it for cash flow if it's cash flowing well? A lot of times, if most of the returns are based on the sale, you're going to want to exit because even though you may have got all your money back out at the refinance, you still have to sit there and wait for your money years down the road. So I would say a 5 to 7 year hold is more typical, but once you're going to see that time period change depending on how the economy is doing, what you're starting to see as normal. One of the reasons that you don't go over 10 years is because most commercial loans have a balloon at 7 to 10 years. You got to refinance it again, and you can't control the environment in which you need to refinance. Like, nobody saw 65% loan to value coming with COVID, and now look, it's the interest rates are low, with the loan to values are also really low, and people are having to refinance in this environment, have to bring more money to the table. You're going to start seeing sales.
Oh, wow, that's good.
They can't get stuck with a loan that isn't refinanced. It's a default, and so they're going to sell it before that.
Okay, and then the last thing I want to talk about was reserves and making sure that the deal you're investing in is well capitalized. If you're looking at two deals, they could be the exact same deal, but there could be pretty different returns depending on how much extra liquidity the operator goes into. Depending on the type of deal I'm looking at, minimum reserve amount I like to see is 6 months of principal and interest payments, and that's on like a light value add deal. If it's a heavy lift, I want to see even more than that, and if it's a ground up construction project, there has to be more than that, because in a ground up it takes 2 years to build usually, and then you actually have to lease it up. So I have another short clip. Where is that clip? I guess it's gone. Reading.
Is that it?
Okay, I think it's here. So these are the reserves I'm talking about. The impact that having reserves can show you the deal that I was looking at.
John, can you turn your volume up just a little bit on your computer? John, do you mind turning up your volume on your computer?
Yeah. So I'll copy these returns so we can compare apples to apples. And so if I go over to my annual cash flow tab, it looks like our total debt service for the year is almost $900,000. And if I go over to, this is like the cost of my entire project, I have $1 million of working capital. So I have two reserve accounts, interest reserve, and working capital. So I'm going in with $1 million worth of working capital, which means I have over a a full year of debt service as a reserve in case something goes wrong, like COVID-19. Well, if I change this to $150,000, now I'm not going in very capitalized. My returns look a whole lot better. This is almost like this is 1.6%. This is a 2% difference on X IRR, so it looks a lot better. But I'm taking on a whole lot of risk, and you really want to compare apples to apples. What you're doing. So I don't know if anyone here knows who Brian Burke is, but he told me about this, and he said he would rather have a 13 to 14% IRR on investment than a 0% IRR, which is what could happen if someone goes into a deal well capitalized. And that's just something that really stuck with me. He's done like thousands of apartment units, has been doing this for like 30 years. And he was like, it's worth going into a deal for less returns if they reduce the risk.
Well, and the reason the returns are less is because the more cash you have to put into a deal, the lower the returns. But it's basically like going to get a 100% loan, 100% mortgage. Your payments are going to be really high, but your cash input is zero, so your returns are going to be great, right? But nobody would do that because it's super risky. And so you're weighing returns against risk. The riskier it is, the higher returns should be. If you want a 15% IRR with low returns, you probably need to go a little higher because it's the riskier the deal, the better returns you should expect.
Right.
Well, I'll take that back. You should never expect returns, right? It's an investment. It is risky. So that's another red flag if somebody tells you these returns are going to happen. The riskier it is, the more likely you are to not get that return. So you should be looking for it to be higher reward. It's like a venture capital firm. They bet big and they lose big. So just watch your risk level and make sure that the returns are coordinated with the risk of the deal. If you see something with a 20% return, ask yourself why. Is it a heavy lift? Is it new development? Like what's going on? If you see it with a really low return, you might say this is super stable in a great market. It's a almost no value add in a market that's appreciating well, stable like Austin or Salt Lake or something like that. You might see a lower return, and you might accept a lower return because there's very little risk in the deal.
Oh yeah, if you get like a 15% like IRR on some new turnkey property in Phoenix, like I would be all over that. Because the upside of just being in that market is so great.
But I would never do a Class D, lift from a slumlord at a 15%. That would have to be like 20 or 30 or more to take on the risk of repositioning that kind of property.
And then this is a bonus. So I thought of something else, and this is 5 things you should know. The tax write-offs of investing as an LP can be massive, especially if you qualify as a real estate professional according to the IRS. So make sure you read through the PPM, which stands for Private Placement Memorandum, and it's the document that a securities attorney drafts up that makes the deal a security. Just read that over, consult with your attorney, and make sure you understand how much depreciation the sponsors are allocating to the limited partners and how much they're taking for themselves. Because if that team takes all of the depreciation or most of it, you may not get the tax write-offs that you were expecting. And if you're a very high-earning real estate professional, that is probably the biggest benefit to investing as a limited partner is the tax benefits.
All right. I love that one because you got to check because everybody's tax situation is different and people talk about the great tax benefits they got, but they'll have a non-working wife is designated as a real estate professional and you have a family where they're both working and neither one of them are, their tax benefit is not going to be the same. So make sure you take that into account. Great benefits, but disproportionate to each person. All right, we got some raised hands. Great. Is that we're right at
Yeah,
time, John. Good
I
job.
think that's it.
So let's grab a couple of questions, and then when we're done with those, we'll just kind of take turns introducing ourselves.
How do I get back to the Google Meet, though?
I can't give you a tech lesson right here.
No,
Perfect.
back.
Perfect. All right, we've got Tanner and Michael Briev. Oh, nice to see you here, Michael.
Thank you. Appreciate it. I have a quick question. So when it comes to the depreciation as an operator or a general partner, do they all divide it up by like, let's say 3 partners, they all divide 33%, or how does the depreciation percentage go?
You're talking about for the general partners?
Yeah, general partners.
So depreciation is interesting because you can actually allocate it up any way you want. Like if one partner needed all of the depreciation, if the other 2 agreed to give it to him or her, they could do that. But you would expect it to be like pro rata with the amount of shares that they have. So if one partner has 50% of the shares, they would get 50% of the depreciation.
Gotcha. But you could, for example, let's say they don't need it, they can transfer their share of the depreciation to somebody else.
Yep.
Yeah, and you can sell depreciation for equity. If you need that on your taxes and your CPA is telling you, you might be able to find an operator who would sell you equity for depreciation. But meet them before you need it. Figure out who those people are first.
Yeah, like John knows what I'm thinking because I got 2 younger brothers. They're not gonna need it.
Yeah, exactly. That's John and my deal. I'm like, how much of this depreciation do you need? He's like, none of it. I'm like, all right, I get it all. One other
Still
thing.
paying for it.
Yeah, that's true.
They're my brothers. They'll take care of me. I take care of them for many years, right?
If they don't need it, if they can't use it because of they are a W-2 worker or for whatever other reasons they just can't use it, then they're happy to pass it along, and they could even sell it to somebody who does need it if they do get a stake. So another thing I wanted to mention, just when we're talking about shares, buying into one of these is a security. You are buying shares in a business. It's regulated by the SEC, and you're going to have Class A, Class B shares. Class A goes to the limited partners. They get paid typically first, preferred returns, and the first crack at a lot of the cash flow. And then you have Class B, which is typically the owners. And I've heard this misunderstood several times from a passive investor because they see Class A and Class B, and they think accredited investors get Class A and non-accredited investors get Class B, and that's not the case. The non-accredited and accredited investors get the same share. They're buying into the same deal, and those are not any different. So if you are not an accredited investor, your only way to invest in these deals is to meet the operator ahead of time and develop a relationship with them, because we're not allowed to share deals that are for accredited investors only, and that means your net worth is over $1 million, not including your personal home, or your income is $200,000 a year, or if married filing jointly, $300,000 a year on your tax return. You can't have a slam to your taxable income and still be accredited if you are taking a lot of tax benefits. So most of us are going to try and qualify on the net worth. That does not mean that you can't invest in these deals. It just means you need to find the operators and meet them and develop a relationship with them before they're allowed to share any of their deals with you. Just it's a way to protect people who are deemed to be less sophisticated investors, protect you from yourself, I guess. So those shares are between limited and general, not between accredited and non-accredited. All right, Tanner, you got your hand up?
My question is there a list of all these hundreds of questions I should be asking a GP, or do I need to put one together and share it with the group?
You can put one together. That would be valuable. But the presentation, you can watch it again and kind of take notes on that. What questions you need to ask. It's really what red flags are you seeing in the financials? And then you're making a list of questions to ask to the operators. The same thing we do when we're evaluating a deal, when we're going in the nitty-gritty underwriting, and we'll see things that are like, what is that? And we just write down a question for the broker, a question for the seller, because it needs explanation, because it's just not jiving with what you're used to. So the more deals you underwrite, the more you're going to recognize outliers in the pattern, and the more you're going to be able to ask the right questions.
Sweet. Thank you.
All right. Anybody else want to holler a question? Who we have down here? Lisa, your hand is up.
Hey, yeah, I have a quick question. So yesterday I was listening to a pitch, and there was two options you had, and let's say the investment was 75,000 in minimum, and it was 10% preference, and then the second option was 75,000 too, but it's a 9% preference, but you get a 70-30 split. So, wouldn't I want to consider the second option? Why would they have two different options?
Ooh, can I answer?
Yes.
Yeah. So I'm going to assume that 10% pref gets paid out before the 9% pref and the split. So it's less risky in that sense because they get paid first. That 9% pref, though, sounds like it has way more upside because if they're meeting all of those returns, you're going to get 9%. And then when they either go to like sell or refinance the property, that's where you capture all that upside. So like personally, I tend to agree with you. I'm like, yeah, I would rather take the 9 pref and the 70-30 split. Just understand if you take that option, and I'm assuming this, but the investors with the 10 pref are going to get paid their entire 10% before you see a dollar.
Yeah, you're right. Yeah, so the 10% would be the first to get paid.
Yeah.
And if you need cash flow up front, like say you're going to retire, and that cash flow is more important to you, take the less risky 10 pref up front. If you are okay with letting it sit and being a little more risky with it and getting the cash flow or the upside on the back end, everybody's different, and that's why you'll have things that are suited to different people because they're trying to attract a wider base of investors.
Oh, okay, so that makes sense.
It's the same with new development. You'll get a syndication together of people who want wildly high returns. New development's going to have 25% returns, 23, 27, somewhere in that range. And you want people who don't need the cash flow because you're not going to see a dime with new development for 2 to 3 years. But they want those big returns. And then when the property starts to stabilize, you actually might buy those investors out and re-syndicate it with a group of what we call coupon clippers who are just looking for nice, stable cash flow because they need to be careful because this is the cash flow that they're living off us. And so you can attract a different bucket of investor depending on the types of returns that you're offering.
Okay, thanks.
Yep.
Does everyone know what a pref is?
Probably not. Shake your head if you don't. Okay.
Right. Yeah.
You forgot to put that in the presentation.
Yeah. Well, you're right. So a pref just means it's a preferred return, and you get paid that before the sponsors get paid anything. Or in Lisa's example, if you're in like I guess a higher bucket, those investors with the 10 pref, they're going to get paid 10% on their money before the investors with the 9 pref get paid $1. And so it's kind of like a loan in a sense that, the lender is the first one to get paid. And then the people with the preferred return, they're the next ones to get paid. And usually the GP is the last one to get paid.
Unless that asset management fee is coming out somewhere along there. That could be taken out after the lender, before the preferred, or after the preferred, but before the profit split. So just pay attention to where that asset management fee is coming out. It's basically who gets paid first, who has the preference, to get paid.
Right.
And 7 pref is pretty typical. You'll see 6. 9 and 10 is pretty high. And so you might have to ask yourself, why is this so high? Is this a risky deal? Who are they trying to entice with this? We were offering a 10 pref on our development deal before we bought the land. People who come in early get rewarded, but it changes once the land is bought and the syndication happens for the construction. So people who come in earlier are usually going to get a better deal. But limited partners, you're all coming in at the same time. So if you want in earlier, you got to be earnest money partner. You got to be willing to front land for development, things like that. You'll get better returns, but also riskier.
10 pref.
That's high.
I know that's high.
And he said it, Katie. It's actually a pretty good market.
Yeah.
I didn't know that 10 was high.
Jump on that right now. I jump on the 9.
Wait, Katie, Texas?
Yeah.
Yeah.
I'm thinking I need some more money so I can invest in one of those.
Yeah, send me that deal, Lisa. So, and this is the key. I mean, I have my own deals. I can put my own money in my own deals, but I want to be a little bit more diversified by putting it, spreading around. Don't put all your money in one deal. If you're freaking out every time something doesn't go perfectly according to plan, you probably put too much money in the deal, right? It never goes according to plan. You're always seeing, this, then, and pivot. You got to have the stomach for that. So if you're over investing in a deal, rethink how you feel when you're going to send that check or wire that. It's a gut check. If you have $1 million, you should spread it around a little. But on the flip side of that, I met somebody recently. He had $1 million in one deal and $500,000 in another, and neither one of them went very well and got a little burned. And so now he won't put more than $50,000 in a deal, and he won't work with the same operator more than twice because he really wants to be more spread out. But because he has so much capital that he needs to place, finding new deals, good deals to invest in is almost a full-time job. So just make sure that the amount of money that you're putting in fits with your risk profile and your risk tolerance, and you're not spreading so thin that it's hard to find good deals. And when you get to that point, when you have that problem, let me know, and I'll put your money to work.
That's a nice pitch.
So I guess that is my pitch. I think if you're a real estate investor, you're always balancing your deal flow with the capital you have available. Sometimes you have more deals and not enough money to pay for it. And sometimes your deal flow is kind of low and people are saying, can you take my money? And balancing those are really difficult. So I'm always looking for more deals, and I'm always looking for more capital. And just, if you've got a successful operator who finds great deals all the time, you're going to have more cracks at the apple than somebody who has a low deal flow. So spread yourself around a little bit, not too much. All right, we've got 22 people left. So give me your one floor elevator pitch. Introduce yourself, what you do, what you need, what you have to offer, and pay attention because these people that you're seeing over and over, these are the people you're going to do business with because you're going to get to know them in these types of situations. And that's the true value of these meetings and why you want to show up live instead of watching the recording is to meet people and get to know each other. But if you are watching the recording, you can still reach out to these people in the group and on social media. So just take the chance to get to know each other. All right, John, you wanna go next, and we'll just go down the line.
Sure. Hi everyone. My name's John Stoeber. I'm currently working on a 34-unit apartment complex with Emma in Little Rock, Arkansas. I do a lot of the financial modeling and day-to-day asset management. And if you are looking to place any money into an apartment complex, you should reach out to one of us because we may have a good investment option for you.
All right. Ben the Builder, next on the list. Ben the Beard. Oh, can't hear him. Are you're muted. Can I unmute you? I can't unmute you. You gotta do that yourself. So we have everybody on.
There we go. Sorry, I'm confused. I got my screen over here because I'm doing like 6 different things as usual. But builder. I'm looking to be on the investment side as well. I'm here learning more about because Stoeber's the numbers guy, and I know numbers to an extent, but I'm not as good as he is, and I don't ever want to be really. I just want to be good enough so when he's telling me what's going on, I can at least understand what he's saying. But I'm looking for projects. I'm building quite a few in town, or going to be building quite a few in town for 2021. Looking really good. Several townhome projects, multifamily, so a lot of duplexes I've got lined up. So I'm just here to network and listen in on this and get some more tips on how to evaluate. Because for me, I've got a lot of people that want to invest. I need to be able to look at properties and see if it's a good deal for me to jump in on, get my lenders lined up, if it's something I want to build or whatever. So yeah, it never hurts to be able to underwrite your own stuff, at least on some level. And then I go to experts that are a lot better than me, like John, to take it from there. So, yep.
All right, thank you,
We should
Ben.
talk because I don't like managing contractors.
Yeah,
Nobody does.
John's coming to Utah to finish my basement. He's going to learn how to manage contractors the hard way, with a teacher right there next to you. Anyway, we're going to go in alphabetical order, you guys. And so if you have Dorian is next, followed by Jason Terry. Dorian, you got 15 seconds. Jason, get yourself unmuted. Get ready.
Hello guys, my name is Dorian. I'm from Austin. I am acquisition manager. I work for different groups. I look for deals here in Texas, and I'm currently working with Emma in a couple of deals here. Just sent a couple of LOIs and working on it. And we're, like Emma said, I mean, if you need any advice or anything, just reach out to me or her, or actually John. So my background is in finance and accounting, so if I can help you with anything, just let me know.
Yeah, Dorian is my Texas version of John. Very helpful, very knowledgeable. All right, Jason, go for it. And next is Jeff Helms.
Yeah, Jason Terry. I'm in the Salt Lake City area. Right now, I'm working on a small development in Columbus, Ohio, and then also just single family in the valley here in Utah, and really focusing on joint venture and raising money. And kind of where I'm at right now is just trying to have a lot of people that are really interested in joint ventures, and eventually I'll hopefully graduate into the syndication side. But
it's the other way around. Joint ventures are easier, and you deal with more high net worth people. So usually we want to graduate to that. So if you got that down, just keep doing it. And then John loves Columbus. You guys should talk. So does Tate. All right, Jeff Helms, followed by Jessica Pariso.
Hey everybody, I'm Jeff Helms. I'm from the Charlotte area of North Carolina. I'm a realtor. I've been in real estate for a couple years now, getting ready to go full time. Been considering multifamily for, 6 months, I guess, and just basically here to learn what I can to get started. I'll be willing to do some, look at some wholesale deals, and just to try to get my feet wet and learn what I can and try to help out any way I can. I'm willing to help anybody that's needs anything if I can give some help.
And that is true. Jeff is helping me on a project right now, so reach out. Very giving guy. But you got to give him something in return. All right, Jessica, followed by John Howard.
Hi all, I'm Jessica Pariso. I'm in Brooklyn, New York, and I heard of Emma on a podcast and connected with her recently, and she was very giving and generous with her time, and we looked at the spreadsheet, her amazing, beautiful spreadsheet. So I'm just starting to get to know this end of things. I'm a broker here in Brooklyn, and I've been working with I have a contractor who I work with a lot on different projects here who wants to team up. And so we might do some fix and flips. We might do some buy and holds. We're kind of looking into that whole thing. And I also have some friends around the country who have a lot of capital. And they say, oh, keep us in mind. So I need to learn more about putting those things together and what that means. And especially in New York, it's just a different, we're not talking much cash flow over here. A lot of appreciation potential, especially with what's going on right now in the city. So there's a lot swirling in my mind, and I want to sit in on these kind of meetings and learn. And if anybody has anything they need, I'm also just an open book here, and will help in any way I certainly can, even if it's just like something you need so I can add some value and learn in the process. I'm all over it.
And Jessica, you might find yourself as a very good capital raiser on someone else's deal someday, because if you have access to that, you can get yourself into a deal just by raising the money for it. If you understand it, you can explain it, then you can do it if you bring the money in. All right, John Howard. We're going to skip John Stoeber, and so after John Howard, we're going to have Karen Lucero.
Hi guys, it's John Howard here. So I am my previous experience. Can you guys hear me?
Yep.
Okay, perfect. So previous experience, just really through I started with wholesaling, and then I kind of went into fix and flips, and it was enjoyable, but I wanted to kind of get into a bigger arena. So I've joined up with a partner of mine. He's more of the analytical person. I guess you're John, Emma.
Yeah.
And he's very all about the numbers. I'm about building relationships, and we're trying to get more investors on our side. We have a few already, but we need to build it significantly and make more of those, building those relationships. I know some high net worth individuals, but we just can't rely on one or two. We like to have a little bit more in our pocket. I'm active duty military and a medic, but I will be retiring soon. So I'm trying to set my family up for the best success possible, and I want to soak up all the knowledge from everyone else to help me go forward, and also help those that are helping me go forward as well.
Nice, thank you,
And
John.
I'm also have a phone call with Emma tomorrow, so I'm looking forward to it.
Yes, I saw the name I recognized. All right, Karen, followed by Kathy, followed by Kenny. You see the alphabetical order here.
Let's see. Hi, everybody. Karen Lucero here. Just kind of starting out. We've saved up some cash to invest in things, but a fool and his money is quickly parted. So I'm learning a lot. Sitting in those meetings. I was in that same Katy, Texas webinar. I'm part of Quest as well. And I'm on a list of a lot of multifamily investment opportunities now because of that. So this has been, timely and hugely helpful to see. I would like to be more than a passive investor, joint venture with some of this capital that we have, but I will keep testing the water and kind of putting some of this money in some of these other things, especially if they're safe. It sounds like it's not a bad way to go. Another project that was presented to me is in Memphis, Tennessee. So anyway, that's where I am, and I'm here to learn as well. So nice to meet everybody.
And Karen, they own their own business and their own office building, so don't let her tell you that she's totally inexperienced, right? So,
oh yes, I was an investor before I was a real estate investor before I knew that I was a real estate investor. So
exactly,
absolutely, we own about 3 properties right now. I'm like, wow, I guess I'm official.
There you go. It's all about confidence. You got it. All right, Kathy, and then Kenny.
Hi, Emma. This is Kathy, and everybody else. This is Kathy Leiby. I'm calling in from Denver, Colorado. I met Emma a few times in the past at different events. Sorry, I didn't catch the beginning of your live broadcast.
We got the recording. It's okay.
Yeah. So anyway, company is Golden Arrow Equity Partners. I'm here in Denver, and we do multifamily syndications around the country. Our primary markets right now are Dallas, Texas, Houston, Texas, and Huntsville, Alabama. We also are starting to do some new construction. We have a project that's starting right now. We're still in the land phase, like you are, Emma. Mm-hmm. And that's a deal we're trying to pay for, that land in the Houston area as well. So that's really exciting. Didn't know a whole lot about how to do land and entitlements and that sort of stuff. And we brought in an experienced partner from California, and it's really fun. So just like Emma, always looking for a good deal in B and C class or land, and always looking for money.
Yep. Thanks for coming, Kathy. Uh-oh.
Sure.
I just lost the recording. That's okay. My computer just went to sleep and... Oh, wait, no, the recording's still on. Good. All right. So Kenny and then Lisa Lau.
Hey, my name is Kenny Ingersoll. I'm in Salt Lake City as well. I'm a financial professional by trade. I'm just looking to network and grow and learn as much as I can, ride on people's coattails and just learn as much as I can. And as mentioned by several others, I could be boots on the ground, do some grunt work, whatever I can do to help to provide value, to add value where I can. Let me know.
Yeah, Kenny's good at the financial stuff as well. So he's learning how to underwrite and identify deals, and so have some things coming down the pike soon. All right, Lisa, followed by Lizette.
Hey, I'm Lisa. I'm based in Houston, and today I still have my 9 to 5 job. I'm actually in strategic marketing, so I do a lot of market analysis and product portfolio management in the energy industry. So I've started delving into real estate investment and hope that I get my first deal. My goal is within the next couple of months. So got my husband bought into it. We also own a coffee shop, L3 Craft Coffee. So go ahead and follow us now, L3. But that's located in Cyprus. So if you're ever in town, come by, then we can chat and have coffee.
Yeah, and Lisa's marketing expertise is coming in handy. She's one of the moderators of the passive group that we're all in. And she has some really great ideas for how to grow the group and improve the networking value of it. So stick around. We've got some stuff coming up. All right, Lizette and then Madeline. Madeline.
I'm in Central Florida, Winter Springs. And what John said at the end of the presentation just really hit home. My husband's an ER physician, and we are in a very high tax bracket. And so we really need to figure out ways to tax shelter. And that's why we're here. That's why I'm here. And I'm brand new to this. I am like drinking from a fire hydrant, but it's also exciting. And so this is my first meeting, and yeah, just looking forward to learning more.
Talk with Emma. She can help you with taxes.
We had a call earlier today about just that. So, all right, who we have? Madeline and then Maria.
Hi everyone, my name is Madeline Yao. I'm here in Central Florida. Just pretty much been in this field for about a year, so it's exciting to meet a lot of you guys and just learn what you guys are looking for and seeing how I'm able to help you guys. I'm analyzing a deal now, 8 unit, about 18 minutes away from my house, so it's exciting, it's scary, but just been underwriting. My background is digital marketing and business intelligence. So I just pretty try to help people increase their occupancy and their revenue. So if you guys want to connect with me.
Yep, she's a researcher extraordinaire, you guys. So if you have some market stuff and you need some questions about that, she can help you out with finding what you need. Business analytics is like the data scientist of business. All right, we got Maria and then Pasha again. So you get to go twice. You get to go once and your mustache gets to go once.
Thank you for pronouncing my name correctly. Usually they say like Marija or Marija, depending like where the people are from. So hi everybody, I'm Maria Sperano. I'm new to the group. I'm from New York, and I work currently as a tax associate in one of the bigger public accounting firms. Recently I got interested into real estate. I'm trying to learn as much as possible and connect to people. My husband has a self-directed IRA that he rolled for his 401k to, and we're looking to invest into deals using his self-directed IRA. And we just got into we did a soft commitment with one of the general partners that we established a relationship with, and now we're just looking to build more relationship and invest in the future.
Perfect. I used to live in the Czech Republic, and I learned how to pronounce names that end in a JA.
Yeah, that's good.
All right, Pasha.
Hello everyone, my name is Pasha. I'm a data scientist at Walmart, and I help Walmart to find real estate deals. Recently, I decided to do it for myself. So I'm actually located in Northwest Arkansas, which is where Missouri, Kansas, and Oklahoma meet Arkansas. I had a chance to invest in 3 properties so far in this area, and I'm working with other investors to find similar properties, usually buy and hold or bear in this area. So feel free to reach out to me for any of these reasons.
And Pasha just bought his first duplex. Yeah.
True.
But I don't know, with that data science helping Walmart find real estate background, we'll get you into commercial. Just give it a minute.
Hopefully.
All right, now.
By the way, my mustache is for grow and mouse save a bro for men's mental and physical health. Just a side note, because this also has its own time. So.
Yeah, it's getting to be like its own personality there, but we're not going to give it its own turn. So we're going to move on to Sean Baxter, Tanner Morrill, and Tate. You're last, man.
Yeah, I'm Sean Baxter. I'm in the Salt Lake area. I've got multiple long-term rentals, looking to get into multi-units, doing some burrs. I've been in the construction industry a good portion of my life, and I'm looking at getting into some short terms also.
Sean, where do you live again?
I'm in the Salt Lake City area.
There you go. Now everybody knows. We'll go grab some lunch here soon. All right, Tanner. I always pronounce your last name wrong. How do you pronounce it?
I pronounce it like the moral of the story.
Okay, good.
So, yeah, so I get whatever you want, though. It's spelled weird. So I'm in the Salt Lake City area. I'm a full-time, I was a full-time real estate agent. I spend most of my time just networking and learning right now in the multifamily space. So I've read a few books over the last 3 months and met a lot of people. So I'm just looking to get into some small existing apartments, and also looking at vacant land that I can build something small on. And it's a pretty bold, but just if you know the right people, you can pull off some big deals. So I have one single family rental right now, and I'm gonna sell that and use that equity next year probably. So I'm excited to network with everybody. If you want to work, I'm kind of just putting together like a 3-man, 4-man group to do some lead generation right now.
Nice. Tanner's at all the stuff. You're like learning from a fire hose right now.
Yeah. Yep.
So dedicated. That's what you're looking for. Somebody who's just drinking it up. You learn fast. All right, Tate, take it away. If you're still here, you're here twice on my list. Okay, going once, going twice. I'll just introduce him. He's in Salt Lake City. He's a multifamily investor, fix and flip return multifamily. He's got a couple of cool deals going on right now. He's building a 20-unit building next door to an existing 20-unit building. So they'll have 40-ish when they're done. And doing some cool stuff. He's done some ground up, some apartment complex flips, things like that. So Tate has a cool podcast and a group that meets every other Tuesday, where we just put kind of like high-level apartment investors together to talk about our business. So anybody's welcome, though. So anyway, that's Tate. And thank you guys, everyone, for coming. I will post this video in the group, and I will also post it on YouTube. And just get out there and start sharing your contact information. Like I said, meet as many operators as you can, just like operators have to meet as many passive investors as they can, because you want more options to invest. You want more options to have partners. So thanks, guys, for coming. We'll see you. We're not going to meet next month. If you're in Salt Lake City, we're going to have a holiday party at the Garage Grill in Draper. I don't know what day yet, but kind of count on that. And then we will meet again in January. All right, everybody, happy holidays.
Thank you.
Goodbye. Yeah.